Hello and a very warm welcome indeed to Beyond Markets, a global webcast for clients and prospects brought to you by Julius Baer. Now, we've been on hiatus over the summer period, but we're delighted to be back with you today as investors prepare to tweak and update their portfolios for the rest of 2023. And over the past weeks, it's been a busy period for our economies. The Julius Baer Market Outlook now reflects that the likelihood of a US recession has dropped from 50% down to 30% as its economy continues to show resilience to interest rate hikes. In fact, the focus has very much switched from west to east when it comes to the challenges that investors are facing. While the US economy is showing continued resiliency, here in Europe, there are still challenges as leading indicators point to slower growth. Meanwhile, in China, the economy is struggling and stimulus measures are needed. Ultimately, things will become more balanced in 2024. This is a very key message here. But now is the time for investors to position themselves for the coming months. In a moment, we'll be hearing from our head of research, Christian Gattiker, on what's in store from central banks as we head into the second half of the year. And of course, you can put your questions to him a little bit later too. First of all, we'll be speaking to Mark Matthews, our head of research in Asia, for insights on what's happening with China and the possible contagion to the rest of the global economy. So if you would like to put your questions to either of our guests today, please don't hesitate to get in touch. You can do that by clicking on the question mark button on the right-hand side of your screen, and your messages will come through to us here in the studio. We will, of course, try to get through as many questions as possible in the next half hour or so. And do bear in mind that this is a global webcast, so we cannot comment on specific investment products or companies. But let's get started, and we're going to head live now to Singapore and our head of research Asia, Mark Matthews, for a specific deep dive into this situation in China. Mark, it's great to have you with us here today for these insights. And we've seen in recent weeks that China's really had to step in to boost its economy with stimulus measures on various parts of the economy, with the interest rate cuts, the support for the housing market. But earlier this year, we were talking about the great reopening of China. So what's been going on?
Hannah, in hindsight, I think we can see the two problems that have prevented the great reopening from happening. The first is that unlike in the West, where you had stimulus as a percent of GDP as high as 20% in many countries, there was really no fiscal or monetary stimulus in China. And so households and companies had to burn through quite a bit of their savings just to survive. I'd also point out that the lockdowns in China were the most severe in the world. So the consequence of those two things is, firstly, people were in much better shape from a financial point of view when they came out of the lockdowns. And secondly, I think that there was significant psychological damage incurred on the population in China because of those very severe lockdowns. Now, at the same time as we had the zero COVID policy, they were doing some other things too. And what they were doing was cracking down on a lot of sectors in the economy. The one which has had the biggest implications is the property sector. And the reason for that is because property is by far the largest sector in China, 30% of GDP. I think the intentions were noble in cracking down on the property sector and frankly, some of the other sectors too. The technology sector, there were monopolistic practices. Private education was forcing parents to spend far more than they could afford on their children. Anyway, what this has caused is a ripple effect through the economy because for most people in China, as is the case in the rest of the world, property is their largest asset, the home they live in. Property prices are down 15% in the big cities. They're down even more in the smaller cities. And so when your largest asset goes down in value, you tend to save more and spend less. And that's exactly what's been happening, Hannah.
It certainly seems like this kind of perfect storm situation, but maybe if we can just dig down a little deeper into the property issues. I mean, how complex is this situation? Because the numbers that you're coming out with are just staggering.
Yes, by the way, property in China is by far the biggest asset in the world, $62 trillion. And I think there's three impacts that I can see of this, of the property sector on the economy in China. The first is that, as I said earlier, it is people's largest asset. So when it falls, they feel poorer, they spend less. And then the other thing I would say is there's a ripple through effect on many other sectors, ancillary sectors, be it the construction industry, the building materials industry, white goods, property agents. And the last thing I would say is there's an impact on the financial sector, not so much on the banks. Property is probably only about 6% of total bank loans. But because it's only 6% and banks were reluctant to lend to property developers, they borrowed in the bond market, both offshore and onshore, and they borrowed from so-called trust companies. A lot of those bonds, as I'm sure you know, technically they're not defaulting, but they're extending the payments. And I suspect they will continue to extend the payments pretty much in perpetuity, and people won't get their money back. I don't know if that is going to have a big impact on the economy because, to put it bluntly, the owners of those bonds are mostly rich people who, I mean, of course, it's painful for them, but most of them will be able to take the loss. The place where it will be more impactful on the economy is the last thing I mentioned, the trust companies. And in China, there are these trust companies that have probably about 21 trillion renminbi. The 10% of those assets are loans to the property sector. We reckon that unofficially the number is probably closer to 30 to 40%. In other words, about $1 trillion of trust companies' assets have been lent out to these property companies, and the investors in the trust companies are more retail investors and companies who were looking for higher returns than they could get in simply bank deposits. So as they don't get paid, and we've seen since July, a number of trust companies have not been paying these investment products that they should have been, that will have a ripple through effect on the appetite for investing and consuming on the part of retail investors and companies in China.
Well, it's certainly no surprise after what you were saying that all eyes are on China. And maybe I could just apologise. We lost connection very slightly there with you, Mark, but we certainly get the impression of the complexity of the situation in China. But really, now that all eyes are focused on what's happening in China, is it more likely that we'll see a policy mistake there than anywhere else in the world?
I think what everybody wants is what former U.S. Treasury Secretary Hank Paulson referred to as the big bazooka. And you might recall that was the term he invented to describe the enormous stimulus that resulted from the global financial crisis back in 2008, 2009. China did more stimulus than anyone else, $500 billion of stimulus in those 2 years. And so people would like them to bring out the big bazooka. Well, it's clear they have no intention of doing that. If there was deflation in China, then I think that would prompt much more action on the part of the government than what we've seen so far, because deflation can lead to a spiral of lower spending. But ironically, the most recent inflation reading in China has taken them back into a positive year-on-year inflation territory again, albeit just tiny, plus 0.1% in August versus minus 0.3% in July. But that was the first positive CPI reading in 5 months. So the irony of that is that it's nice they're getting, they're exiting deflation, but it means it's less likely that they will do a large amount of stimulus. Now, we could wake up one morning and they do a lot of stimulus. That's the nature of a command economy. But I'd put the odds of that at only about 10%. I think things have to get much, much worse than they are now for the government in China to decide to do major stimulus.
And what about this idea of a balance sheet recession? Some economists are saying that this is what China is now facing. What is that, and what is our view?
It simply means when asset prices fall, people feel less wealthy, and they tend to save and want to pay down their loans, and that has obviously a detrimental impact on economic growth. I must confess that the similarity with Japan is uncanny, and Japan is of course, the country that people most often refer to when they're talking about a balance sheet recession, because in Japan, property prices peaked in 1991. At that time, they were 4 times the size of the economy, the property assets in Japan, I should say. We can all remember that famous example of the imperial palace in Tokyo being worth more than all of California. Well, anyway, after that, and it took several decades, property prices fell 80%. And by the way, in 1991 in Japan, that was the year, coincidentally, that their working age population peaked. The reason I say it's uncannily similar with China today is that property prices in China peaked in 2021, and yet they are still 3 times GDP, even though they're down 15%, as I said earlier, from the peak. And the working age population in China peaked in 2011. Now, what we saw in Japan as a result of that massive deflation in asset values was that people were unwilling to spend for the better part of 20 years because they saw their property values go down every year and the stock market went down every year. In China, what we are seeing today is a much less demand for loans and an increase in savings among households. And so I do find the situation to be quite similar with what Japan experienced in the 90s.
Very interesting indeed. Maybe just because you're mentioning Japan, could you briefly give us some insights into how what is happening in China is affecting the rest of Asia?
Well, there is an impact on the slow economy in China. Their exports, I should say their imports into China are down about 8% in August over August last year. I could just give you a little anecdote. In Thailand in 2019, the year before the pandemic, they got 11 million tourists from China. And in the first half of this year, they only got 500,000 tourists from China. So yes, there is an impact, but ironically, there's also a good side to it because, of course, the whole world has been grappling with this big spike in inflation. For China to be growing as slowly as it probably is means it's exporting deflation to the rest of the world and helping the rest of the world bring down inflation.
And of course, then we've also noticed in the news recently that all eyes are also focused on India as an alternative investment area.
Yes, for good reason. The country that will contribute more to world economic growth in the next decade is India, more than any other. And there's 2 things that I would say about India. The first is that their working age population will continue to grow, and it'll surpass 1 billion people by the end of this decade. What that means is that they'll be making more and more money. Ernst & Young forecast that per capita GDP in India, which was $2,600 last year, will reach $3,700 by the end of the decade. So people will be consuming more. Morgan Stanley estimates the retail market, which was $780 billion last year, will get up to $1.8 trillion by the end of the decade. But also, people will be investing more in equities. In 2015, India introduced something called the Systemic Investment Plan, which means that every month people put a little bit of money into the stock market. And we've seen in countries like Australia how powerful these kind of retirement saving plans are for the equity market, because every month there's literally over 500 million people in India who are buying a little bit of stocks. And the wealthier they get and the more people do that, the more of a cushion, a strong cushion there is for the equity market. And the second point I'd like to make about India is that the infrastructure has improved dramatically. I'll start with the digital infrastructure. In India, 95% of adults have something called an Aadhaar card. And the Aadhaar card is a one-stop shop for doing all kinds of payments, receiving and sending various payments, also through a system that they have called the UPI system, which is an automatic electronic payment system. And essentially that means the economy in India has become highly digitalized. And as a result of that, the small and medium-sized enterprises, which had not been paying taxes, are now doing so. And it took about 5 years for them to get comfortable with that, but they are now, and as a result, tax collection record highs, and the government has taken that money and spent it on physical infrastructure, like highways and airports, and that has made India a place where manufacturers can locate. And so it's in a prime position to take advantage of the realignment of global supply chains, because multinational companies can see this enormous population, which is becoming increasingly affluent, and now a physical infrastructure to manufacture things in India for the domestic population, but as well for exporting. And if that's the case, if India is exporting more, but also is increasingly importing less because they're making things in India, that has big implications for the currency, because it means the current account deficit, which has always dragged down their currency, is swinging into a surplus. In fact, that's already happened. So I would expect a lot less pressure on the currency than we've seen in the last 2 decades.
Mark, thank you so much. I know that you're going to stay with us for any questions that our audience do have. I very much enjoy your anecdotes, your wealth of information, so thank you very much indeed for that. Remember to get your questions in if you can for Mark, and also for Christian, who has been waiting so very patiently for us to come to you. So we talked very briefly there about the impact or the fallout expected from China to the rest of Asia, but there's a reason that we've spent so much time discussing China, is that there are implications much more globally. What are we thinking here?
Well, first of all, it's the broader emerging market space beyond emerging markets in Asia. It also goes to Latin America, Africa, and so forth. But then beyond that, it's actually also affecting Europe in quite a heavy manner. Europe has been, especially after devaluing the euro for years, they've been kind of serving the mass markets, which are emerging market dominated markets, and which are very dependent on Chinese demand. And the European industry is very much relying on Chinese demand. First and foremost, the German industry. I think we already see the slowdown, the weakness of demand happening there, and therefore I think we have these kind of second round effects on a global scale, especially via the export channel. Mm-hmm.
And this has implications for currencies as well.
Yes, indeed. Yeah, this is very much reflected, of course, in the affected currencies. If this gets settled in euros in particular, when it's traded with the eurozone, the euro actually suffers. And we've seen these kind of jittery situations now in the past few weeks. I think it also, despite the fact, that we've been kind of banging the drum that the dollar cannot stay forever that strong as it is, given the government deficit and so forth, the yield advantage still pays off. And then if you see what's happening in terms of demand for euros, I think, the dollar weakness, unless there's really complete U-turn, as Mark outlined, if we suddenly get a complete U-turn in China, I think that we'll see further euro weakness, and also other emerging market currencies will be negatively affected by this Chinese slump.
Okay, so the playbook for the rest of 2023 may look a little bit different now that we have this situation in China. But essentially what we said almost at the very beginning of this year, I believe, this is all about a cool down, and that continues.
Yes, indeed. Yeah, I think we had very, very many shifts and changes on a regional basis, but the overall biggest trend has been this cool down, in particular in inflation, but unfortunately, and that's the price you pay, also in growth. So we've seen this, and now the question is, and this is probably the dominant theme now in the second half of the year, because we're not debating the 2023 growth inflation picture. We're basically looking in markets what's happening in 2024.
Mm-hmm. And that's when we will actually start to see central banks making changes, actually cutting rates potentially.
Yes, indeed. That said, actually they will cut later than initially thought. Actually, the economy has been very resilient, in particular in the United States, but also the domestic markets in Europe have been very resilient. The wages are going up, inflation is going down, purchasing power is there. So from that point of view, actually, we don't see odds of a broad-based recession. And that leads also to the fact that central banks don't have an immediate reason to cut rates. Actually, I would turn it around and say, it would be a bad sign if they had to cut right away in the first half, because actually they would have basically committed a policy mistake. If you still are kind of ramping up rates until mid-year in the case of the Fed, and maybe we'll have another ECB rate hike, and then you have to cut 3 to 6 months later, basically you got it wrong. We think the economy is resilient, that's good news, but the rate cuts will be somewhat later. We expect they will come next summer and will be rather kind of very gradual.
Mm-hmm. Well, this must be good news then for investors, that it's going to be a much more stable transition. And I mean, of course, there are always opportunities for investment, no matter what the economic background. And so to get us started on that discussion, our colleague, who is head of equity strategy, Matthew Racheter, he actually got on his bike to explain more about 4 key areas of investment.
They say make hay when the sun shines. And as we bask in glorious summer sun here in the Northern Hemisphere, there are 4 equally bright spots for equity investors to seek out right now, all of which don't depend so much on the current market environment. First up, automotives and manufacturing construction. Both areas are still benefiting from pent-up demand generated during the COVID-19 pandemic. Not only that, but car manufacturers are also tending to generate more sustainable cash flows and have healthier balance sheets than before the corona crisis. Meanwhile, when it comes to manufacturing construction, public buildings, warehouses and data centers benefit not only from government stimulus in the US, but also from companies needing new premises as they relocate their operations back to the US. The electrification of the economy, driven by increased connectivity, digitalization and e-mobility, means that the demand for electricity will rise. Good news for electrical equipment suppliers. And finally, the latest surge in artificial intelligence has shown that AI will play a leading role for generations to come, which means that leading-edge companies in the semiconductor space will remain in high demand. So, although economic growth might be declining, these 4 bright spots will add some shine to your portfolio.
Well, our thanks to our colleague Matthew for that. But I think the message is really clear that there are pockets of bright spots, but it's more than just that. Now is the time to invest, Christian.
Yes, indeed. I think it's always tempting to procrastinate and kind of push it into the future. Let's wait and see. I think the time to invest is now, because we're basically at crossroads. I think we have to take sides now. Either you follow our recommendation and go fully invested, because we think rates will come down to a certain extent, things will cool off. This will be a boost to many of the assets which suffered from higher rates, and actually will be negative for cash. That's our scenario. Or you have a completely different opinion, that we're going into a high inflation, 70s style of situation. But there you shouldn't own cash either, because that's actually where you lose most in real terms. You need to go into real assets, into gold, into anything which basically protects your wealth. So I think especially after this summer, where we've seen some intermediate euphoria that are now completely cooled off and got pushed out of the market. I think now the seasonality, September, October, is the ideal time to basically make the next steps.
All right, well, let's talk about sectors. When it comes to equities, Matthew mentioned artificial intelligence. I mean, there's a lot of hype around there. But are valuations too high? What's your opinion?
They're sporty. Valuations are,
I like that.
and of course, given the growth prospects, usually valuations are basically shrugged off until they mature. Usually, when growth cools off, that's when valuations start to really mature. We don't see that happening for the time being. Our main recommendation is to basically kind of buy the picks and shovel providers, like in a gold rush, the guys who are providing the equipment rather than the ones using them. So that means, that's the one that provide the machinery, which is semiconductors, which is chips. They benefit big time from this, and the other ones benefiting most is the ones that run the platforms, so the cloud computing providers. And I think this is kind of the ecosystem we look at right now. What we can't know, and where it's most interesting to see, is what it actually does to those using it. If you compare it to the electrification of the industry 150 years ago, it was almost impossible to see what was going to happen to the ones who were using this electricity and were ramping up big time in terms of efficiency. I think that we have a few suspicions, but that remains to be seen. For the time being, it's about picks and shovels, it's about semis and cloud computing.
And outside AI, when it comes to equities, where do you have your preferences? I know we've spoken about healthcare, for example, but...
Yeah, exactly. Well, given where we come from, we think cool off, which means lower growth, trouble in China, no big support from a cyclical perspective. I think this is really where you want to own growth stocks, meaning stocks that can outgrow the economy. If this were to turn, if we had tomorrow the big stimulus announced in China, we would revise that. But for the time being, it's really about the ones that are able to even grow in a very challenging environment. That's some of these technology companies, communications, but also healthcare. We think healthcare is completely underrated. We had a major buying opportunity when we were holding this call last time in June. We still think it's undervalued. Now, exactly in the largest pharma market of the world, we have a few risk factors out of the picture because there was an announcement on how the pharma sector was affected by these government initiatives to cut prices. So I think that's done now, and now we can look at the future earnings, which are very resilient and almost completely insulated to the economy.
And I ask you this question for healthcare, but also outside of this sector. Should investors be looking more at US equities or European-based equities, given the differing situation with their economies, with the running men that we saw earlier?
In regional terms, if you're a growth investor, you invest your money in US stocks and Switzerland. That's the growth market. Compared to the US, of course, Switzerland is rather a minor one, but these are the ones who exactly have, by definition, by their currency setup, have this kind of fostering of growth companies. And therefore, for the time being, we see more opportunities as opposed to Eurozone, where 50% of the companies listed there are cyclical, so are basically tied into this global business cycle, which is now kind of hampered by the Chinese indecisions. So for the time being, we think and we fear, that this environment will actually hold on much longer than we wish for. For the time being, possibly into next year, this is about growth, this is about US stocks, this is about kind of being very cautious and very selective in some of the other spaces.
All right, well, we've got lots of your questions coming in, so thank you for that. We'll get to them in just one moment, but I did want to talk to you briefly about fixed income. I mean, that has been an incredible ride, really, for fixed income over recent months. Where do we stand on this asset class? Still going for quality, but emerging markets?
No, I'm afraid the emerging markets opportunity is again very much tied into the Chinese situation, and we don't have anything. Our major call was about high grades in Asia, but what we really and that's why we downgraded the area. What we don't like about it is simply that it doesn't even account for the risks that are out there. And so in other words, there are no spreads. You don't get any extra return now investing there, and therefore we got more cautious, and we think the rest of the world, and in particular the US market in long-dated safe haven bonds is so attractive. I mean, if you had these type of 4% yields a few years back, everybody would have bought in. You needed kind of triple leverage to achieve these type of rates, and now you get them kind of plain vanilla. So we think this is the time to lock in these rates and just hang in there and clip the coupons.
Okay, well, let's get to your questions, and there are a couple on China. I'm going to put them to Mark, but Christian, please just jump in if you desire. Mark, thank you for sticking with us. I think this first question just kind of hits the nail on the head. Has China now become permanently uninvestable?
I'm sure not. I mean, China has a 3,000-year history behind it, and it probably has, many, many more thousands of years to come. But to tell you where the bottom is and how long we stay at the bottom and when we go up, it's a tough thing for me to answer. I think the best case scenario is still one that would make us refrain from investing it, which is that it just goes sideways for a few years. And that's similar to what happened around 10 years ago when President Xi Jinping first took power, and there was a lot of anti-corruption efforts and generally efforts to remove excesses in the economy, and that resulted in a very just sort of sideways market for about 3 or 4 years, and ultimately after that it took off because the technology stocks started growing a lot. So it will be investable for sure at some stage, but I can't say when, and I think in front of us we've probably got at least a few years before it does become investable.
And just to follow up on the Chinese property issue, somebody has a great question that really kind of leans into the important policy implications. Do you think the key issue in Chinese property is structural oversupply? So similar to what happened in Dubai and Las Vegas after the global financial crisis, or did they simply build too quickly and that actually that oversupply will be eventually absorbed over time?
Yes, that is the issue. There's probably around 50 million vacant residential units in China now, which is about 20% of the total stock. And that's far too high, of course. So that is the main problem. And then ultimately, it's not a sector that should be a third of the economy. That doesn't make sense, in any place except maybe a tiny city-state where you've got enormous population crammed into a small space. But that's not China. So I think they're doing the right thing. And I think 10 years from now, we'll probably look back and realize that it was the right thing to do. But unfortunately, it's like taking hard medicine. It's really painful as long as the medicine's being administered. And as I said, I think this medicine will continue to be administered for a few more years to come in property and in other sectors of the economy where there were imbalances that were genuinely starting to have a negative impact on society in terms of the gap between the rich and the poor, as I said earlier, monopolistic practices, etc.
Well, I mean, the figures that you're saying to us, Mark, are absolutely eye-watering. So I think it will be very interesting to watch this space over the coming years. For now, though, thank you very much indeed, Mark. Just to wrap things up, really then a question for you, Christian, on stock markets. Do we expect a US stock market rally after the turbulent August, September so far?
Yes, we do, and we think the seasonality actually is playing out quite nicely this year, and will continue to do so. So we expect that we're in a bottoming process right now. Some chit is possible, but then we expect a very benign end of the year, so fourth quarter, and this is the time to get positioned for that now, and not kind of just chase the news, but be ahead of the curve.
And what sectors would you see riding that wave?
I think, well, again, excluding the China stimulus thing, which would then change things, I think this is about the growth sectors we just named, the communications, IT, and healthcare as well. Maybe you can add a bit of spice more tactically, which might be also other areas which are more cyclical, some of the ones that were mentioned, electrical engineering companies. But I think, this is about being broad-based. This will be a broad-based and actually also a broadening rally that we're going to see, because it's been a very concentrated one in the first half of the year.
Somebody's asking, if you believe that the stock markets in Asia to also be kind of dragged down by what's happening in China, but maybe you can add to what Mark said earlier on India. I mean, this is a huge growth story.
Yeah, the main beneficiary of the woes of their neighbors, because we saw with the new iPhone release that now the producer there is now for the first time using India as a sourcing thing. And before we are more like opportunistic hot money going into India as kind of an alternative to the long-term China story. That was the story of the past 10 years. Now we actually see long-term money and foreign direct investment moving into the space, and the demographic search is fabulous there. I think it's despite what you might perceive to be a hype, I think this is the time to take a first step or dip your toe into the water and start investing there. A
very confident set of questions from you, or set of answers from you today. Thank you very much indeed to Christian for all your inputs, and also to you as well, Mark, for joining us live from Singapore. Now, of course, there are still lots of ways that you can stay in touch with what's happening on the markets. From us here at Julius Baer, we have 2 podcasts that are updated regularly. The Beyond Markets podcast, that is updated every week with insights from around the world on different industries and different sectors. So you can join that by clicking on the QR code, or just type in Beyond Markets into whatever platform you get your podcasts from. Also, if you want more daily insights, we have a Moving Markets podcast, which has the latest moves of the market and guest speakers from Christian's research team joining them every single day. So there's plenty to get stuck into. Thank you so much for being there. We'll be back next month with a look at future cities. I know it's going to be very exciting. It's one of our big major megatrends that we're following here at Julius Baer, and we're looking forward to bringing you more on that next month. Bye-bye.